I'm Howie Lim. This is Money Hacks by the Business Times. If your financial life feels like a perpetual layover, stuck between retail products you've outgrown and private banking that hasn't noticed you, you are not alone. Today we tackle the mass affluent trap and the quiet corrosive cost of idle cash. Is your liquidity serving your goals, or is it just gathering dust while inflation chips away at your future? What are some real-world strategies you need to move beyond simple saving? Welcome to Money Hacks. I'm Howie Lim. And today we get expert help from Stephanie Leung, CIO of StashAway. Stephanie, thanks for joining us.
Hi, thank you for having me.
So this mass affluent sector feels like the financial equivalent of a layover, like I said. You've got more money than retail products are designed for, and perhaps not enough to warrant the attention of a traditional private bank. Why is this specific cohort falling through the cracks?
Yes, indeed. I think the mass affluent sector is a big segment, and a lot of us actually fall in that segment. However, this segment is also traditionally one of the most underserved segments. In our definition, a lot of them have a net worth of between $2 and $10 million to invest. However, if you take that amount to go to a private bank, for example, you will be kind of at the lower tier of a private bank, and you may not get the best service that a private bank can offer you. Now, of course, if you go to a mass retail bank, they would offer you very undifferentiated products, and some of the advisors that you would get are probably busy, serving many, many different customers. It's a really underserved segment in the sense that, you have all this wealth to get invested, but you're not getting the service that you deserve.
Do you see any real-world costs to the mass affluent then?
There is a lot of cost in the sense that your money is not working in the best way for you. And we're trying our best to use technology to help to provide the most personalized service to this group and to help them to invest for the longer term, offering some of the best-in-class investment products at a very, very cost-effective price. So, for example, our managed portfolios and also our alternative offerings are using some of the most cost-efficient fronts. For example, ETFs in the public market, and then also we partner with very, very high-quality providers in the alternative space, offering us the best that is accessible to our mass affluent investors. We also provide a lot of financial guidance. Every month, we publish a sale insight, which talks about the macro views as well as how you should allocate some of your capital. We have a lot of personal finance materials from an educational perspective, ranging from a weekly buzz to webinars that we host ourselves, as well as with our partners. And then lastly, of course, through the digital journey and also through talking to our human wealth advisors, our mass affluent customers can get a lot of personalized financial guidance from those different interfaces.
Maybe the cost of idle cash is worse than most people assume. Beyond simple inflation, Stephanie, what are we actually losing? Is this purely a math problem regarding yields, or is it a fundamental misunderstanding of what liquidity should actually do for you?
The cost of holding cash is number one. If you stack your money in the bed, you lose to interest. And that is something that a lot of people understand. That's why you put your cash in the bank to try to earn interest, to try to beat inflation. However, what we're more concerned about is that cash in the bank is actually not earning what they're supposed to earn, because this cash can actually be invested in investment assets over the long term, offering you a much higher return. If we look at the past 30 years, investing in equities give you about 11% per annum in annual return, whereas just putting money in the bank give you like 1 to 2%. That 10% difference and compounded over 30 years, that difference is actually very, very, very big. That determines at retirement what kind of lifestyle a particular investor can actually afford. We actually ran a lot of numbers in our latest insights, and a regular investor who has done 30 years of investment, putting in just $10,000 a year, over 30 years, that investor would have accumulated $2 million in net wealth, versus somebody who just put that money into the bank, earning $386,000. And that is actually a very, very significant difference. So if your time horizon is 30 or 20 years, your biggest question shouldn't be, okay, where am I going to get an extra 50 basis points in cash rates? But the question should be, okay, I need to start investing right now. And how am I going to start investing so that I can reap the benefit of that 10% or even higher return over the course of a very long time period?
What do you think retail investors miss that professionals take for granted?
As a professional investor, myself and my fellow colleagues understand very, very clearly is that it's very hard to beat the market in two ways. First way, in terms of beating the benchmark, so beating a broad index. And there's actually a lot of statistics to show that. For example, if you look at all the fund managers that are managing portfolios that covers US equity, most of them actually underperform the benchmark. Only a very, very few percentage of them manage to outperform the benchmark itself. So professional money managers understand that it's very hard to beat the benchmark. And a lot of retail investors, when they invest, they only invest in a few stocks. By investing in a few stocks, actually what you are implicitly saying is that you think you can actually outperform the broader market by selecting those very few stocks, which professionals understand that is very hard to do. Secondly, professionals also understand that it's very hard to time the market. This is also something that's underappreciated by retail investors because a lot of retail investors actually are looking to, for example, buy the dip and sell at the top and try to trade the market in and out by using market timing to generate return. And this is extremely hard to do, as most professional investors would understand. This is not a sustainable way to generate alpha and generate returns. So I think those are two kind of misconceptions that professional investors understand, but retail investors still try to do.
Still to come, when do some of these tried and tested frameworks actually break? And also, maybe we're too obsessed with efficiency and yield and holding on to cash. More with Stephanie Leung from StashAway in a moment.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. Stephanie, some advocate for a specific split across cash, income, and growth. It's clean, but it's also flexible, maybe too flexible. When does this framework actually break? And under what market conditions does the approach stop working altogether?
Yeah, I think that some of the traditional asset allocation frameworks would dictate how much you should invest in bond versus equity, for example, according to your age. A common framework is called a 60-40, right? If you moderate risk in your midlife, you should invest in 40% bonds, 60% equity. It's quite simple strategy and it has proven to work. However, what we do for our managed portfolio is also that we think ahead. We kind of look forward to not just next year, but next decades to come. And therefore, when we look at the traditional 60-40, what we realize is that there are some missing pieces. And the most important missing piece is that there's no allocation to gold. 2 years ago, we made the asset allocation decision to include gold in all our asset allocation portfolios because if we look forward, we're looking at a world where, number one, governments are all raising debt and spending quite a lot on a fiscal basis. I mean, that naturally leads to a less attractive fixed income environment for investment going forward. Secondly, when we look at the inflation globally because of the spending, in terms of fiscal policy, because of the increased geopolitical conflict across the world, we think that we're in a world where inflation remains quite sticky. And in that world, again, as we all know, inflation is actually bad for bonds. And therefore, if you were to build a balanced portfolio, you shouldn't just think about bond as the only safety asset. Instead, have a healthy dose of gold to help you to balance out the risky assets. The other trend that we're seeing is that more and more investors are investing into alternatives to diversify away from just traditional assets like equity and bond. We think that's a credible way to build resilient portfolios that can help investors to stay invested throughout different cycles.
Yeah, of course, geopolitics and such, plus the Fed's making decisions that often ripple through every portfolio. How much should we, the average Singaporean investor, be obsessing over these headlines versus focusing on your own thing?
Yeah, I think it's very hard, right? Every day you're bombarded with headlines about what the Fed is thinking about and what Trump is talking about, and markets actually react to it. Market goes up, market goes down, and you end up being quite confused and may never start to invest. What most investors should focus on is number one, of course, to start investing, but also think about what you invest in. We found that by far, what is much more important is not when you invest, right? It's not if you time the market correctly, but it's about what you invest in. One of the misunderstanding of a lot of retail investors is that you can just pick a few stocks and beat the market. So for most people who don't have a full-time job to sort of look at the market, I think really the best way is to not think about the what problem, but just invest in the broadest set of asset classes as possible. And as we all know, ETFs is one of the very best way to express that broad market view. And you don't have to answer the question of what to invest in. Now, the second question of, okay, when do you invest? I mean, it really doesn't matter when we look at regular investing, which is something that we think helps to solve the when problem, meaning that basically you just set a fixed schedule of investing in that broad market index that you've chosen. So it doesn't matter if your fixed schedule is monthly, quarterly, or even daily. The results aren't that different. But the important thing is that you get invested and you get invested regularly, because the difference between not investing and investing costs a lot, and that changes how you can afford a retirement life.
Let's talk about our Singapore cash approach, if you will. Is this current obsession with efficiency and yield just a temporary symptom of our high rate environment, or has the Singaporean approach to holding cash been just fundamentally flawed?
Understandably, most Asians, not just Singaporeans, actually have a lot of their net worth in cash and in the bank earning interest rates. This is actually in stark contrast with the investor behaviors that we observe in the US or Europe, where most people actually invest their net worth. Of course, it has a lot to do with our cultural tradition of, okay, saving for the rainy days and not being too risk-taking. But I think if you look at equity markets or if you look at asset classes, you construct a portfolio which is well-balanced, which has the right time horizon, which is not just relying on very single stock-focused concentrated positions, it can actually be quite a safe asset to own over time, especially compared to cash. Rather than spending time on looking at, okay, where am I going to get that incremental 20 basis points or 50 basis points, really most investors should look at, do I actually have too much in cash? If, let's say, you have more than a year's spending in cash, the extra cash on top of that spending, which is your safety net, should be invested. And you should really think about getting started, picking the right products, picking the right platform, and also, doing a regular investing. A lot of our investors actually do it on a monthly basis because that aligns with their monthly paycheck.
Okay, Stephanie, if someone takes your advice today, perfectly aligns their cash, income, growth, what's the biggest unknown or risk that they still expose themselves to that nobody really talks about?
Yeah, I think when people think about investments, most people think returns first. So the first question that most people will ask is, okay, how much return am I going to get on this investment? What most people miss when they make an investment decision is, what kind of risk am I taking when I'm making that investment decision? Now, risk can come on many forms. I think most people are concerned about drawdown risk. So when you invest in public markets, particularly the ones that are quite volatile, you would go through periods when you see a markdown and you may see negative returns on your investments. And it's really about the psychological impact that it has on you in terms of, can you actually stay invested through that very difficult period? My simple test is actually, can you sleep at night with, let's say, your portfolio down 20%? That's why we've designed a range of different balanced portfolios that can help people to really think about the risk question when you first invest. So for example, if you can't sleep at night with a 30% drawdown in a portfolio, that means that portfolio is probably too risky for you. So perhaps maybe you should choose actually a lower risk portfolio. Now, of course, it's not so easy to construct these portfolios. So, what we do is that we've already constructed all these different risk appetite portfolios, so you don't have to do the hard work. And the only hard work that an investor needs to do is really ask himself or herself, what kind of risk is he or she willing to take in order to get the commensurate return?
I really appreciate your insights today, Stephanie. Thank you so much for joining us.
Thank you.
Stephanie Leung, Group Chief CIO of StashAway. This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.